Nirmal, ladies and gentlemen. I'm Hiral Dadia. We have with us Mr. Devendra Kumar Pant, Chief Economist at India Ratings and Research, joining in. Welcome to the show, Mr. Pant, and always a pleasure to speak to you and get insights from you as well. Mr. Pant, overall, last couple of months, we've seen a key challenge with regards to where inflation goes across economies. And secondly, if you see in terms of where growth is concerned, that has started to pick up. However, majority of the central banks have been trying to squeeze out liquidity from the system as well by increasing rates. What's your read of the situation?
Well, Hiral, the situation is gradually improving, one can say, or finding its place normalization. As we had seen in past few days, especially after 12th of August when the inflation print came below 7, people have started talking about the inflation has peaked and we should not go and look at monetary tightening. We should, in fact, some people have also started talking about it will be too very soon the RBA has to cut rates. But this is too early to celebrate. So when I say too early to celebrate, if you go back and look at where were we till September, October last year. September, October last year, our inflation was really way too low, around 1 or 2% annualized YOY growth. But what happened? So what is happening around? Yes, we are seeing the developed world is slipping into recession. China is though not in recession but cooling off. So this is, yes, there is pressure on commodities to correct. The Brent crude has come below $100 a barrel. That's will give a lot of breathing space to us. Currency, the way it is behaving. So look at it this way: commodity expanding by 5% and currency flat. So what affects us in the rupee term. So there's that 5%. Commodity is correcting by 5%. But currency weakening by 10% will hit us by 5%. So what we are looking at, we are looking only the dollar price, whereas if you look at the currency is weakening. Why it is weakening, all of us know, because we are going to have very high current account deficit this year, closer to 3% and that always puts pressure, especially at a time when the capital flows are not there. It has just started. On the equity side, some flows have started coming in, but forex is slipping below India's external debt in the last couple of years. So that's a concern. Inflation at any point of time, not only in India, globally, will remain the biggest risk. And unless that risk is taken care of, it is unlikely that any economy will have a sustained growth.
Right. So with all of this said and done, if you see in terms of India as well, what's the GDP that you are anticipating in terms of the first quarter of FY23?
So first quarter FY23, we are expecting a growth of 13.3%. Again, if you look at last couple of years numbers are all over the place. We look at first quarter 21, it was contraction of 23.8%, 20.1% growth in last year first quarter, and we are expecting 13.3%. If you look at what is the market expectation, generally it varies between 12 to 15% or 16%. But the way to look at it, from first quarter of FY20, right? So it's a 3-year period. What is the CAGR for this 3-year period? With 13.3% growth in expected growth in first quarter FY23, 3-year CAGR between first quarter FY20 and first quarter FY23 will be only 1.2%. So it is just the base effect which is playing around. And even if one looks at the RBI's number quarterly growth numbers, which they had given with the August Monetary Policy Committee report, we are looking at economy slipping back from double digit to high single digit in second quarter, and third and fourth quarter coming down closer to 4%, which is nothing but similar to where the annual growth in FY20 was 3.7%, or the first quarter of FY20, which was 4.6%. And from there, the growth has gone down. So the point which we should be focusing on and which should be looking at, has there been any changes in 3 years? Yes, there are some. We have started all this Make in India, so some of the import demand will go down. So then we are having the PLI scheme that will give benefit from in medium to long run. Some of the benefit may start coming in from the end of this year or maybe early next year, but demand, that is the crucial question. The demand, the private final consumption expenditure, which is around 55 to 60% of the economy, how that is behaving. And if you look at over a longer period from FY12 to FY21, based on the national accounts data, the wage growth is trending downward. Now, this is nominal wage growth is trending downward. And if you take care of inflation, then growth will come down drastically. So at a time when the growth is coming down, we are seeing the household leverage going up, and some of the consumption we are doing is the leverage buyout. Household savings have gone down. That is not giving a very great picture on the consumption front. So unless wage growth comes back to normalcy, it is unlikely that the consumption demand will sustain. So we'll have both up and down. Like it may show some increase in one couple of quarters because of the base, and then may come down. So consumption is a main worry for the Indian economy as of today.
Right. So with all of that said and done, how are you expecting the current account deficit and the fiscal deficit side of it to pan out?
So current account as on today, because the situation is so fluid. So even if you look at the oil averaging around $100 a barrel or thereabout, maybe give and take a couple of dollars a barrel, and currency having a depreciation of around 5% or so. But looking at the current account, we are expecting current account somewhere to around 3.1 to 3.2% of the GDP. More worry is if our because of slow recession in the global world, if our services exports are affected, because though on the good side we have deficit, but when we look at services export, on the services side, we have a monthly surplus of somewhere around $7 billion. So around $7 billion worth of services export in excess of the services import. Now, with the global economy or the developed world slowing down, if there is a hit to that, then we will and add on this. But in the recent time, we had seen even when the global economy has gone down, our remittances hasn't been affected. So remittances have grown. They had grown. The growth slows down when during adverse time. So we are looking at the current account at 3.1%. Coming to the fiscal deficit. So fiscal deficit, again, there are so many moving parts because what you see, the windfall gain tax every week of 15 days that is being revised. So what we had seen when the budget was presented, the numbers on the revenue side were very pessimist. So we were expecting that the tax revenue collection will be around 1 to 1.5 trillion rupee more than what was budgeted for, and that gives some phase, like during the year, if government has to undertake any fiscal measure, any support or anything to take care of that. Then came the excise duty cut, and then came the windfall. So initial windfall tax calculations were that there will be the revenue collection by windfall gain tax will be more than what is the excise hit government has taken. And but the other side was that we were looking at oil marketing companies having a loss of somewhere around 47,000 crore during the year because their pump prices were lower. And we had seen all the first quarter result of oil marketing companies. They have shown losses. Based on that, there was some space available. Now, since the crude has corrected, so there will be some impact of that on the current account. So simple back of envelope calculation is $5 a barrel increase in the crude price leads to $6.6 billion increase in the current account deficit. So when the oil was 120.40, we were looking at a higher deficit, but now around 3.1 or so. Fiscal deficit, as on today's way the thing stands, I think it will be closer to the budget estimate of 6.4% of the GDP, because in value term it may be more, but in percentage of GDP, because GDP numbers is again very pessimist in the budget. So we are going to have a higher GDP, nominal GDP than what is assumed in the budget.
Right. And with all of this, what's your anticipation, Mr. Pant, in terms of the bond yields and the impact on the Indian rupee?
So the bond yield initially, when we were in the beginning of the year, we were somewhere around 760 or 770 on the 10-year by end of March. But post that, there has been so many changes. There was surprise cooling of bond yields past few days, and I think they came all the way down to 712. And I think today morning they were trading somewhere around 7. Yesterday it was some 724 or so. We were of the view that it will be somewhere. We are of the view it will be somewhere around 780 to 8 during the at the end of this fiscal.
Sorry, if you can just come back, what are we expecting?
Somewhere around 780 by end of the fiscal.
780, okay.
Yeah, because if what is baked in another 50 basis point, 25 to 50 basis point hike in repo rate, which is more data dependent, because right now the situation is how the global and domestic data will come in, and based on that 25 to 50 bips increase will take place, and that will have some impact on the rates. How the liquidity, like withdrawal from accommodation, or whether it will change to neutral, that will also play out in the minds of investor. How from here onward, the government borrowing, because what we had seen in FY21, government has borrowed more than what was their deficit financing requirement, and they ended fiscal year 21 with a surplus with RBI to the extent of 1.8 trillion rupee. So what do they decide? Whether they continue to borrow more than what is required to finance the deficit? That will play its part on how the bond yields will move. And unknown in entire bond yield discussion is how the state yields, state borrowings will take place. Though we have some estimate of how much the states are going to borrow. But if you look at Department of Expenditure, Ministry of Finance monthly report for the June 2022, and even right from the beginning, from the March 2022, they have been saying the off-budget borrowing of the state public enterprises will be part of state borrowing. And initial discussion or initial order from the decision from the union government was that off-budget borrowing of FY21 and FY22 will be adjusted from the net borrowing in next 5 years, which was making it for some states the situation was very difficult. So which is now changed to like whatever. So you can say the grandfathering till FY21. So whatever they have borrowed in FY22 of budget borrowing, that will be netted out for in next 5 years. So the borrowings of the states will go down, and unfortunately, the data on the state side, and especially on the off-balance sheet borrowing or what the state public sector enterprises have borrowed, is very dated. Even if you look at the CAG reports, you will get the latest data for FY19. So that extent how much the state public sector enterprises have borrowed, it's an unknown number, and its impact of that amount adjustment in next 5 years, how much will be the state gross market borrowing will go down and how much net market borrowing will go down, that's an unknown number. Now, if that number becomes significant, say something around close to 1 lakh crore or whatever, or so, then you will see the bond yields going up by less than 780. Then the bond yields may go up by may increase to 760 or 770 odd or so. But that's an unknown number for all of us as on today. So yeah, and currency because we are expecting close to 5% appreciation average during the year. So point estimate of currency doesn't make much sense, because when you look at the macro numbers, they are average for the year. So, but for FY23, we are expecting closer to 5% appreciation in the currency over average for FY22.
Right. So overall, my last question coming to you, Mr. Pant, is, so what would you say in terms of the Indian economy as compared to the other economies maybe developing or developed? Are we in a better place or are we in the same situation?
It depends, like optimist, pessimist, like half full or glass half full or half empty. Ultimately, it's only the 50% which is filled up. If you look at the numbers, headline numbers, it tells you, it gives an impression that we are in a much better shape than where the rest of the economies or big size economies. I'm not talking about the smaller economies, where the big size economies are. So entire developed market, developed world, we are looking at a recession. We are looking at significant cooling off in China. So on that count, we look like 7%. That is what is our forecast for FY23 as on today. Looks a very good achievement. But if I go back and look at it, how these things have panned out. Right, a lot of it is because of base effect. If one looks at compared to FY20 in 3-year journey where we are, assuming real growth is 7% this year, what is our forecast, that gives an CAGR of 2.8% between FY20 and 23. And that's a realistic way of looking at these numbers, where the numbers are very volatile. Looking at 6.6% degrowth in 21, 8.7 in growth in 2022, average growth 1%. So average growth around 1% is nothing but recessionary condition. It's not a recession, it's a recessionary condition. It's the flattest growth, no growth. Now on that, we are growing at 7%, CAGR for 3 year 2.8%. Doesn't give very great picture. But yes, if you factor in, now another problem is last year a lot has come because of exports, right? Merchandise export. And do we expect the same performance to continue in 23? Answer is unlikely. Because a large part of that growth was price driven. And not all the sectors, if we try to map it with the production sectors on IIP, not all the sectors benefited. It was a handful of the sectors where exports growth has helped those sectors to grow in the domestic production measured by the IIP. So what has happened in certain sectors where the domestic demand was weak, the export demand has helped for that sectors to grow, but where the domestic demand was relatively strong, there we had seen the pump up in or the sharp growth in IIP, index of industrial production. In that situation, the exports, because at the end of the day, when we are looking at the school textbook macroeconomic identity, the last two terms, X minus M, export minus import, which is nothing but our current account. Now, if the current account is going to 3.1, this means it is pulling out a lot of money, a lot of GDP out. So, export story is not going to play the same way as in FY22. So, when I say the export story, it's the trade story. So you will export, you will import, and you have more netting out than what you are adding up. But yes, in the medium to long run, somehow the wages has to grow.
Correct.
Unfortunately, with high inflation and low wage growth, real purchasing power of a common person is going down, and that is having an impact on not only the consumption growth but overall GDP growth. And if the consumption growth is not picking, then expecting an investment revival is questionable. So you may see some sort of brownfield expansion, but for the greenfield expansion, adding more capacity, you have to have consumption growing, and that consumption can grow on if and only if the real wages are growing, and real wages will grow with the same nominal wage growth if inflation comes down. And if inflation has to come down, you have to have monetary policy action and wait for its result, because monetary policy will not control inflation. In short run, it will take 6 to 9 months to have its
impact. Absolutely. It's like a domino effect that needs to be tracked very closely by everyone. But thank you, Mr. Pant, for a great explanation, and your views coming in helps us understand things a lot better. Thank you. Stay safe, and happy Janmashtami to you as well as all our viewers as well today.
Thank you, and thanks for having me on the show, and happy Janmashtami to you and your viewers too.
Thank you.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.